please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning and welcome to Bazaar Morning Call. I am Anuj, with me of course Sonia and in a bit Lata also with us. Of course this morning is interesting because we have a lot of headwinds right now, crude oil being top of that at around $78, so that will have some influence. Today's expiry as well, and we have seen a lot of pressure on the market, especially in the broader market over the last 2 or 3 days. Let's see how the expiry pans out. Sonia, good morning. Lata, good morning.
Oh, good morning, Anuj. Sorry for that momentary delay. Yes, I mean, I think you put it in a nutshell. It's not just crude. I would worry even about emerging markets. I mean, the way China is panning out, what we have to come to terms with is a very steep fall in the yuan. It's kind of not come in as a very big topic, but after yesterday's fall, yesterday the yuan also again fell about almost 0.5%. So now it works to almost the similar fall that we saw in December 2015 and Jan 2016, you know, when there was that big fear of money flowing out of China. There could be bigger problems of the old leveraged firms, their state-owned NBFCs, that bad loan not cleaned up, India going through similar problems. So there's something really, China is in a bear terrain as far as stocks are concerned, we know that already. And therefore, that currency could hit the Indian currency as well, as we are already seeing it happen. You know, I would personally not look at a falling rupee as negative. It's good for the economy. Otherwise, you lose out to a lot of competition. You open your doors to a lot of import floods. But immediately, it becomes destabilizing. And then separately, we have a local problem in terms of extra volatility and, the additional surveillance measures that SEBI and the exchanges are introducing. That's creating its own problems. So global problems are coming with some local technical issues. And therefore, we have to worry. Yesterday, the breaking of the range, the 10,700, 10,900 range, should make us sit up because it is coming in a context of global emerging market weakness.
Yeah. Not just breaking of the range. I mean, morning Lata, morning Anuj. I guess it's also the kind of sell-off that we're seeing in the mid-cap end, right? I mean, not just the usual stocks, the vulnerable stocks, but now I was just looking at the list of 52-week lows. I mean, names like Jet Airways, Motherson Sumi, Jain Irrigation, NMDC, BEL, just makes you sit up and worry about what the texture of this market has become. Anuj, is that the bigger worry about how the mid-cap portfolios are bleeding so much now? You know,
Sonia, good morning. Lata will recall that for last 2 or 3 months, it's been my call that, it's showing signs of, repeat of 2008. I mean, perhaps not to that extent, but initial signs were there. Look, I did a poll yesterday, a Twitter poll, and I got a decent sample size. When we made this graphics, I got 3,500 votes, now almost approaching 4,000 votes. Basically, I asked people, how's your portfolio done in 2018? 39% people's portfolio is down over 30%. That's a good enough indicator of what we have right now. And 29% are between 15 to 30%. Only 8% people with gain. And most of them, because they have been in the largest of large cap stocks. Yesterday, the internal that we spotted was the number of stocks hitting 52-week low. 293 was the number. What was the number yesterday? 492. 492. So another 200 stock hit 52-week low yesterday, and on an average, a BSE stock is down 37% from peak. A group stocks are also down. 68 of the A group stocks are at 52-week low, but the bigger problem is where the retail is. And most of the retail normally is in the B group. And we're not even talking about the T group and the Z group. B group is good group, normally decent mid-cap stocks. 342 of the stocks in the BSE in the B group are at 52-week low. And one more thing, while the Nifty is down 0.6% this month and the mid-cap index is down 3.8%, TCS, Reliance and HDFC have contributed 1% to Nifty this month, 3 stocks. So that's cushioned the market's fall. Having said all of that, money is made in stock market by being on the other side of both greed and fear. Right now, I think what we saw yesterday was fear. What we saw yesterday was panic. And for me, we have still not broken the absolute, yes, 10,650 to 10,900 has been the range. For breaking of that range, you'll need to close below 10,593, which if you see the highs and lows was the previous low. So closing below 10,593 would be a real indicator of breakdown. Otherwise, there's still a good chance that purely on index level, just on the Nifty, you may have actually revisited the lower end of the band. And once the series is over, once the panic is over, July you start in a decent note and you once again try to get back into that range. Yesterday there was no major FI selling, there was no major DI selling. Yesterday was a telltale sign of PMS redemption. So PMS redemption, when PMS redemptions happen, that normally is an indicator of last leg of falling. I'm not saying that, you know, it cannot revisit, but since broader markets are in bear territory already, and you saw a lot of panic yesterday, today's expiry, normally, as I said, in good quality stocks, you end up making money if you buy the fear. So good quality stocks should be bought, but the B group and C group and, you know, all these groups, they should be avoided for now. And, you know, in a lot of these stocks, you don't have exit right now. But this is not at index level a bear market or a breaking down of the market. For that, you'll need to go below 10,500. And a lot of index stocks are still doing well. So let's see if, you know, today we can see some kind of recovery. A couple of Asian markets are already recovering, by the way. So let us see if there's some recovery.
It is generally, as they say, hard to catch the falling knife, right?
Yeah.
I mean, even with good quality names, so Motherson Sumi, Ashok Leyland, Jet Airways, for example, you don't know where the fall could end. I mean, it could still be another 30% fall from here, right?
Yeah, you know, so for example, you know, you will know that Motherson Sumi, for example, perhaps in 2 or 3 years will hit a new high.
Yeah.
You know, perhaps Ashok Leyland in next 2 or 3 years will hit a new high. I'm not too sure about Jet Airways. So, you know, of course, you'll have to identify, you know, some of the stocks where you have to accumulate now. And again, if you manage to get into cash, get into large caps over the last 3 or 4 months, which should have been the strategy, by the way, in that case, perhaps now you're getting good chance to accumulate some good stocks in the broader market, because you will never catch the absolute bottom. Having said all of that, for next few days, I think you still want to avoid B group, because the fall in B group sometimes can be so large and so vicious, and there are no volumes. You know, you try to sell a stock.
There's no volume.
You know,
that is the bigger problem.
You try to sell a stock. The PMS redemption that we're talking about, and you know, in certain cases, PMSs are down 35%, 40%. That's notional value. If you go and sell in these volumes, just your portfolio selling will, you know, induce a circuit. You know, you just go out and try to sell 50,000 shares of, say, IRB in this market. You'll have the stock down 5%. You try to sell, say, Mahanagar Gas, 10 lots of Mahanagar Gas. The stock will be down 5%. That is the problem right now, because it's a bit of a hated segment right now. There's no exit as well, right?
Okay. Now, that said, I really would want to worry about the global scenario. If 10,600 or 593, as you say, is a Lakshman Rekha, if the global markets can take a tumble, which looks like, you know, China is looking vulnerable at this point in time, then we could, you know, cross that Rubicon line, as it were. But there's nothing that drastic in the Indian economic scenario. Basically, if you look, whether you looked at inflation, whether you look at earnings growth, it doesn't look like there should be any reason for us to capitulate at an index level. But global markets can, you know, spoil the mood a goodish bit. Crude, and for us, both things are going against us. Crude going back again towards that 78 mark. Pressure from the United States that we should not be buying from Iran. And yesterday, Nirmala Sitharaman and Sushma Swaraj's meeting getting cancelled. Their prospective meeting with the United States, or at least getting postponed. So, you know, sometimes news like this can trigger. And I just want to point out even the news that Economic Times has reported today in terms of that ARC or that AMC not being formed. This is exactly what the bankers were telling me yesterday, that you have to put serious money behind an ARC if that has to work. And the government is not in a mood to put, you know, some 50,000 crores or 60,000 crores behind an ARC and buy. So we're going to get some very bad numbers from public sector banks again, simply because old loans, the provisioning now has to be, you know, the third and the fourth year, the provisioning increases dramatically. So you could get a situation where things get much worse before they get better. That can't be ruled out, especially in the second-rate stocks, in the A group stocks, as you call them.
Okay, well, it is also expiry today, so add to all the volatility, you have to take into consideration expiry as well. But let's start the show and tell you what our wise experts have to say as we headed to trade this morning. Mahesh Nandurkar of CLSA talks about the takeaways from the corporates they hosted at the India Access Day in London recently. Most companies highlighted that green shoots are visible in discretionary consumption demand.
And these could be important because we have seen the rupee take a bit of a knock. Mohan Chenoy of Kotak Mahindra Bank believes that global markets are witnessing a risk-off scenario as trade wars intensify. Oil prices remain elevated due to supply disruption from Iran and tightening US monetary policy. He believes as the Chinese Yuan weakens sharply, EM currencies are particularly under pressure. Rupee is testing all-time low of 69 and looks vulnerable for further weakening towards the 70 level. Mohan expects to see a trading range of 68.80 to 69.10 against the dollar today. That, in a sense, would be historic. If we did reach 69, this would be the weakest since the taper tantrum. Yeah. And that's why it's important. I want to reiterate that most central banks want the currency to weaken in a situation of trade wars. You know, when tariffs go up, if your currency weakens, you will still be able to remain competitive. So don't look at it as a national disaster. We need to weaken so that we can compete.
Okay, let's also talk about the bonds and the expectation for today. Mohan Shenoy adds that the yields have given up all the gains of the past week due to a surge in oil prices and the depreciating rupee. He believes that the intermittent OMO purchases by the RBI has not helped in improving the sentiments. He expects the 10-year benchmark bond yield to trade between 7.85 to 7.90% for the trading day.
Okay, Nigel's back from his leave. Nigel, welcome back and present the world view.
Well, thanks so much for that, Anuj. Well, overnight, the US markets, they had a seesaw session. They were trading well in the green with a gain of around 250 points. The Dow corrected nearly around 400 points from the highest point of the day. Initially, those markets were reacting to news that the crackdown on Chinese investments by the Trump administration, that was not as harsh as earlier expected. So that's why we saw a rally. But after that, we had selling in both IT names as well as financials. Top financial stocks that were selling off. You had Bank of America, Merrill Lynch, JP Morgan. You also had the likes of Citigroup that did see some selling. The Nasdaq, though, that was a relative underperformer. That's because heavyweight stocks like Intel did sell off. We had Amazon as well that was under some pressure, and Alphabet as well did see selling. The problem for India, though, is that crude prices have continued to move up. So three broad reasons. One is that there is supply disruptions in Libya as well as Canada. Yesterday, late in the trading session, we were reacting to news that US officials are saying don't import oil from Iran. And the third factor really was that the crude drawdown in US was higher than expected. That's why we saw a bigger move on NYMEX than on Brent crude prices. European markets, though, they in fact ended well in the green. All the three frontliners, they ended with good gains in yesterday's trading session. Asian markets, a little bit nervous today. Most of them trading in the red, though they've recovered from the low point of the day. The SGX Nifty, though, is indicating a more or less flattish start to a mild negative start to kickstart trade. Back to you all.
Okay. Well, thanks a lot for that. And I'm sure we're going to revisit those cues over and over again, Nigel. And actually, starting now, because we have with us a guest who is watching Indian skies very closely from the United States. Arvind Sanger, Managing Partner of Geosphere Capital Management, joins us now. Good morning, Arvind. Thank you very much for joining us. You know, suddenly in the last few weeks, the emerging market scene has gotten very, very cloudy. While Brazil, Argentina, the Turkish political scenario, all of them have been developing. Suddenly, China is becoming even much more of a problem. The yuan has fallen by 3% in the last few days. Is this likely to balloon into something nasty?
We don't know because we are seeing, much more sustained pressure from the U.S. In terms of trade war threat, tariffs threat, as well as technology kind of, exports threat. So I think that China is under the gun, and there is some question whether China is letting the yuan fall to offset the tariffs, or the yuan is falling on its own. But China is seeing a slowdown, and you had the Chinese central bank, loosen some of the reserve requirements, and that again creates somewhat looser monetary policy, and that also causes a downward pressure on the currency. So I think that there are many factors, and it's not clear which factor is dominating, but clearly it creates a lot of stress for other emerging markets when the largest emerging market in the world and the second largest economy in the world is seeing this kind of pressure and is seeing this kind of currency weakness.
Okay, Arvind, good morning. What about India? You know, last year the best asset class in the world was perhaps Indian small cap. Right now, it's the most hated one. Your thoughts on what's happening to the broader universe? Is this just a case of excesses being washed out, or is there something more sinister?
Well, I mean, and I've said this before on your show a few weeks ago, I think oil is headed to $85 to $90. I may have said, going higher from 80, but I feel very, strongly that as we see the Iranian sanctions bite in the next few months, and we get surprised by the fact that lack of infrastructure in the U.S. causes oil exports or oil production growth in the U.S. to severely fall short of expectations. If both those happen, which we expect to happen, then oil is going much higher to kill demand. And that's the problem for India and China and other emerging markets. What kind of oil prices is it going to cause oil demand to slow down? And frankly, the way oil demand slows down is the economy sees some pressure. So I think what you have is an economy in India that is finally clicking at a time when the macro headwinds are just starting to gear up. So looking at all the recent data in India is frankly not very useful. What we have to look at is what will the data look like if global demand growth has to slow down for oil and Indian demand growth has to slow down? What is the economic implications for the rest of the economy? And I think that's kind of the risk that, whether it is inflation or is the central bank interest rate policy of RBI, or it is any other metric, I think there are headwinds ahead, and that creates, frankly, a flight to liquidity and a flight to large caps, which is understandable and clearly, where we were seeing a financialization of assets as a theme that was playing out in India over the last few years. We're now seeing a reversal of that theme as people get nervous and look to get out of financial assets. So I think, I don't think the Indian stock market cycle on a long-term basis is over, but I think it is under severe stress this year, and we've already got into correction territory for the small caps. I don't think the overall market is bulletproof, and the large caps are bulletproof if oil prices continue to climb as I expect they might.
Okay, Arvind, hi, good morning. If you go by the old adage, you should be greedy when the market is fearful, right? I mean, is that the way to approach this market now? Deploy some cash into large caps, or do you think it's better to just stay away for a bit?
I think that deploying cash into large caps vis-a-vis small caps may be a good idea, but if large caps have not fallen and the assumption that they're bulletproof in a sell-off, then I think that's a risky bet. My sense is the market is headed lower, including the large caps. Yes, but I think it is under severe stress this year, and we've already got into correction territory for the small caps. I don't think the overall market is bulletproof, and the large caps are bulletproof if oil prices continue to climb as I expect they might.
Okay, Arvind, hi, good morning. If you go by the old adage, you should be greedy when the market is fearful, right? I mean, is that the way to approach this market now? Deploy some cash into large caps, or do you think it's better to just stay away for a bit?
I think that deploying cash into large caps vis-a-vis small caps may be a good idea, but if large caps have not fallen and the assumption that they're bulletproof in a sell-off, then I think that's a risky bet. My sense is the market is headed lower, including the large caps. Yes, you step into a market when there's fear, but I'm not sure that the fear is widespread enough, or the stocks look sold out enough, or washed out enough that we can say that the fear is widely prevalent and therefore it's time to step in. I do think that we have to be patient and be greedy. And what I mean by greedy is, whereas in the past I would have said that if we get a pullback to a reasonable level, you don't want to be too cute and miss it. Now I think we can afford to be greedy and wait for things to get really attractive before stepping up, because I don't think there is any rush of money coming into this market, either from global investors or certainly from domestic investors. Last year, domestic investors were driving the market. This year, at least, looks like domestic investors are licking their chops and are also looking to take money off the table. So I don't think we're at levels of pain yet where the market looks, compellingly cheap.
Arvind, from what you have told both Anuj and Sonia to their questions is that there could be a perfect storm building in terms of higher crude prices and a Chinese triggered currency question mark. I mean, the rupee is within handshaking distance of an all-time low. 69 looks round the corner, maybe today, according to some of the experts. But the difference between now and 2013 is that clearly there is growth now, as you pointed out. So do you think, again, to extend Sonia's question, this should be the time to buy? Because the storm is coming at a time when other fundamentals are at least clicking, especially growth. And if that is so, where are you buying? I mean, are you going to buy the IT stocks? Are you going to buy pharma stocks? Would you be buying consumption stocks? Where would you train your eyes?
Well, I mean, you were talking a little earlier about somebody like a Motherson Sumi. And let me first say one thing. 2013 you're comparing to. Well, the index, Indian equity index, is significely higher. So let's separate the rupee from the index, right? The rupee, given where the rest of the currencies have gone, given the inflation differential versus the US, has done quite well. So a moderate depreciation from here really shouldn't mean much, because over time the rupee is not going to, not test at 69 and exceed that 69 level. So I think getting overexcited about the fact that rupee may go to 70, I don't think in the overall global context that's that big a deal to 5 years later get back to those levels after having been stable for a few years. But if we talk about the index is significantly higher than where it was in 2013. So yes, earnings are better, but the index is better. And I think the real challenge here is that the global headwinds, there was just a taper tantrum fear, but the global headwinds today are somewhat more broad-based, and it is not about the taper anymore or about the Fed raising it. It's about trade war. It's about pressure on China and Chinese currency weakness, and it is about oil prices going up sharply now. In 2013, oil prices were $90 to $100, so you can say they're lower than that, but they've gone up sharply in the last few months, and they could continue to rise. So I think there are a different set of circumstances why today the market could see some correction. But you're right. I mean, we're not seeing this as a end of the cycle, and we are going to be greedy to buy. We're just going to be a little bit patient, because we don't think there's enough fear yet. Yes, mid caps have corrected, mid and small caps have corrected 30%, but we think unless we get some sell-off in the large caps and a broad-based sell-off, we don't think there is broad enough pain yet to say, it's all hunky-dory and let's get back into large cap, because that's a safe place to be. Okay, so apart from crude oil, Arvind, what could be the catalyst of that large cap fall? There's one, school of thought which believes that the FANG stocks perhaps are in a bubble territory, and that could be the next catalyst for a big global breakdown. Would you agree with that view? I'm sorry, which type of stocks did you just mention? The FANG stocks in the US. Okay, yeah, I mean, I think I agree. I agree that the FANG stocks, the technology kind of bellwethers that have held up this market, they are amongst the most global companies. They are amongst the best beneficiaries of selling around the globe. And if global tensions continue to rise, and if global, tensions in terms of trade and in terms of restriction on sales by U.S. of technology to China, if all of that continues to happen, then I think that clearly if that bastion falls, the NASDAQ has been a significant outperformer versus the S&P year to date. And if that starts to give way, which I think is likely if this market continues to correct, that is not going to remain an isolated island, then I think that does create a broader risk for global, large caps also. So if we are looking for, stocks or companies to buy in this market, maybe not now, in the due course of the next couple of months, you briefly mentioned names like Motherson Sumi. Is this the time to be looking at these names? Not just Motherson Sumi, I mean, Ashok Leyland has fallen so much, a whole host of other Torrent Power. Good quality companies have been falling quite a bit. Do you look at this space now? Absolutely. Absolutely. Those would be the type of companies that we would be most interested in, because our view is that, this is not a time to buy low-quality stocks with the questionable management, you're going to get an opportunity to buy high-quality stocks with solid managements and solid long-term growth outlook, which are having some headwinds. I mean, let's take Motherson Sumi as an example. There is talk about U.S. threatening to put tariffs on European car imports. That would be a big deal for car sales of European companies, which would be a big deal for Motherson Sumi's growth outlook. So those are real business risks which could cause some earnings risk near term. But to the extent that these trade tensions are going to play out relatively soon, and we'll know what the impact is, and at that point we can make a clear-eyed assessment of how much, if any, impact will be there on the real demand. Then a company like that with an excellent track record of returns and of acquisitions and of growth is one that we would definitely be interested in. Okay. Similarly, you mentioned Ashok Leyland. I think they've done a phenomenal job in the domestic market, and they have some long-term growth opportunities in exports and in defense sales. So I think this is a company with a lot of things going for it, and that would be another name. So I think that that's exactly it. On the other hand, let's take companies like HDFC Bank or some of the others that have not sold off at all. It's hard to say that those are the ones one should one should add money to, because those stocks have not had any impact of the sell-off. But the other ones you mentioned, the high-quality names which have sold off, that's where we are most interested right now.
Okay, can you just expand that list? I mean, rather than me put words in your mouth, where would you want prices to fall and gravitate towards them, and where would you buy anyways straight away?
So, I mean, another name I would mention would be somebody like an L&T, right? That's a domestic, I think CapEx cycle is just starting. Infrastructure spending is going on. Housing might be recovering. That could be an interesting name. Another area we are very interested in is real estate. This is a sector that has done nothing for the last 5 or 6 years. You have, seeming to be that the cycle is starting to turn. If people are looking at inflation and getting a little bit more interested in hard assets in an inflationary environment, and where financial assets are becoming a little bit less exciting, then real estate is a sector where there's a lot of pent-up demand because of multi-year lack of demand growth. And we think, some of these companies, DLF is in the market doing an equity offering, getting essentially debt-free. That's a large cap name. There are other names which are high quality that, have done a little better. So it's harder to get excited about them unless they sell off. But that's a sector we're quite interested in. So, there are select areas that we think there are opportunities if stocks sell off. As to when exactly we would buy, it's it's hard to say, but we are keeping an eye on valuations, and we are keeping an eye on market sentiment. And our sense is market sentiment has clearly moved from greed to moderate fear, but it has not gone to panic yet. And I think that somewhere between moderate fear and great fear and panic is when we think the buying opportunities are going to come into play.
Last question from my side, Arvind. What about a set of 6 or 7 stocks this year which have made huge money and continue to see money chasing some of these stocks? Britannia, Page Industries, Hindustan Unilever, the Bajaj Finance, Avenue Supermarts of the world. What about some of these names?
Well, I think that these are domestic demand stories. And domestic demand stories have some of the most nosebleed type of multiples. We frankly don't disagree that the domestic demand story may have somewhat more secure fundamentals, but we just have a hard time with valuations. So at the end of the day, these stocks are at the higher end of historical valuations. We'd like to see valuations come down. So the sectors are good. Some of the multiples are not so exciting.
All right. Arvind, we're loath to say goodbye to you, but I think it's time you have to retire for the day. So thank you very much for joining us, staying up for us. We have to take a break. We are coming back with a check on some of the stocks that should be on your radar today.